everyone. Welcome back to the Vancouver Resource Investment Conference 2026 here in beautiful BC, Vancouver, as you can tell by the name of the conference. Now, it is wonderful outside, and it's been very interesting inside. Obviously, we're dealing with those $5,000 gold price, $100 silver, but volatility has returned to the currency market. We have seen the Japanese yen surge nearly 2% in a single session, coupled with reports from the Bloomberg that the New York Fed has been conducting rate checks with major financial institutions. Now, in the world of central banking, a rate check is rarely just a casual inquiry. It often is a warning shot. It signals that the bond market is stressed and the central banks are being forced to coordinate, possibly in the background. Now, the question for investors obviously is simple. If the system requires this level of emergency management just to remain stable, where is the true safe haven and what does that mean for trust? Joining me to discuss this trust horizon and the shift in the global settlement assets is, of course, Matt Piepenburg. He's a partner of Greyerz AG. Nice to see you.
Good to be back.
Matt, there's so many things to talk about. You just came off stage, and I think that the base of that conversation has been around trust and what that means for the debasement trade. Before we do that, I want to start with this data because, I mean, the Japanese yen surged 1.75% on Friday following reports of the New York Fed doing these rate checks. And I guess the question is the U.S. preparing to intervene because they want to save the yen, or are they kind of preventing Japan from dumping U.S. treasuries themselves?
It's all connected and it's all chaotic. Rates, currencies, spreads, yields, and debt, of course. And then, of course, that translates into the end road of all conversations, precious metals, of course. Yeah. But before I was a precious metals person, I was a risk asset person, and the smartest guys in the room were always the bond guys. And I've said in almost every article I've ever written is the bond market is the thing. You have to understand yields. It doesn't need to be complex, but as bond prices go down, yields go up. And yields are the cost of debt. So yields matter. Yeah. And all the stock jocks were good, but it was the credit guys who got the best plays on equities. And so how does this all tie together to your question? I mean, look, the Japanese carry trade, most of your viewers know, when there was low-rate arbitrage, borrow in yen, borrow at low rates, invest in foreign markets, including the S&P, pay it back at a lower interest rate, and hope you don't get caught in a currency squeeze. So that's a very simple Japanese carry trade. That works when yields are low and the yen is cheap, right? If the Japanese have to sell a lot of their JGBs, their Japanese government bonds, to save their yen, which is overextended in debt, so debt is all related. Well, if they have to sell a lot of U.S. treasuries, that puts pressure on the U.S. bond market, pushes yields up there. And so they have to save their yen by selling U.S. assets to keep their yen under control. And for the first time in what seemed impossible, yields in the Japanese yield curve are rising. Yeah. So that can be a massive, it's a symbol of bond dysfunction. By the way, French bond markets, UK bond markets, Japanese bond markets, US bond markets, all seeing yield spikes because trust in their fundamental IOUs. When you talk about debt to GDP, Japan's off the chart. But it's not the home of the world reserve currency. They have less room. So this is a major theme. But if yields are rising and bonds are falling, that's very bad for Japan and the Japanese carry trade. It's very bad for the S&P because a lot of that money on the carry trade went into S&P assets. Ironically, it can be very good for gold. I know I'm saying this with my bias selling my book, but a lot of the money used in the Japanese carry trade was used to short the gold price and used on the COMEX. So it's so convoluted, it's so intentionally complex. But when you see rates rising or yields rising, I've always said that's a shark fin. It's a symptom of danger coming to risk asset markets because yields rising just means the cost of debt is rising. And everything from Japan to the UK, certainly to the US and France, is driven now more by debt than GDP or productivity or real manufacturing. So if we're a debt-based system gone way too far and the cost of debt gets higher, that puts a lot of stress on all markets, all politicians, all policies, and they're running out of good options. Yeah. Because the only way to get those shark fins underwater again is to buy more bonds that no one else wants. The only way to pay for that is to mouse click money at a central bank near you. That debases the currency, hence gold and silver at all-time highs. More so, the system has gone slowly, and as Hemingway says, all at once into a crisis. The spikes we're seeing in gold and silver have a lot of reasons. The primary reason goes back to 1971. It's a currency crisis. It's a credit crisis. And I'm simplifying, but after 50 plus years of playing this game, our currency, your problem is now our currency, our problem for everyone. Because we've all been living beyond our means in debt, monetizing that debt with mouse-click currencies, and the currencies are trusted.
Yeah, it's interesting. I mean, that multi-decade high that we talked about on the Japanese yen trade, I mean, I guess we could ask you if that is the signal, that risk-free, status of sovereign debt is. I mean, we're talking about trust. It's gone.
Well, think about it. That was the two pillars of America in any country, but certainly America was its bond and the petrodollar. Yeah. But Japan, any national sovereign, it needs to have trust in its IOUs to continue to function. And when you see those rising yields, what does that mean? Less trust. It needs to be a higher premium to lend to that nation. And when you see that in one-off scenarios in developing economies or emerging markets, you kind of see that movie before upside down and backwards in South America and other headlines. And you see that in Japan, you see that in the UK, with the gilt crisis we saw many times already, but this is, and obviously with the US Treasury, the risk-free return of that sacred cow, the 10-year US Treasury, the basis of the world trading system, derivative system, SWIFT system, everything is tied to that. And when that yield is rising and trust in that is falling, the evidence which is everywhere, well, the risk-free return is really return-free risk. Yeah. And when you're measuring that yield against inflation, again, this is not sensational. Everyone I know on the street, from John Williams reports, but it's not an exaggeration, knows that inflation is double digits. I mean, we know this. And so we're really getting no return. You're getting return-free risk for the most supposedly safe tier one asset in the world. And the reason is very simple. Nations with their backs against the debt wall in a corner need to run negative real rates. That's wonky language. They need inflation to be higher than the yields so they can inflate away their debt. They just get away with that by reporting it incorrectly. I know that sounds sensational, but this is as old as History 101, and it's an absolute theft because they have their cake and eat it too. They run negative real rates to inflate away their debt on the backs of everyone on the street, top 10% to bottom 10%. We need inflation. Don't want to report politically incorrect, but we just will lie about the inflation rate. Yeah. It's that simple.
So, I mean, the counter, when we talk about it, I mean, if the Fed comes in and, stabilizes the yen at 150, I mean, most people would say, doesn't that prove that they still have the tools to manage this? But does that just give them the ability to kick the can down a little bit further?
Anytime you solve a problem with mouse click money to stabilize something, technically you can make sure that the S&P never goes below threshold, never goes below median. You can literally synthetically make it a deficit without tears and a market that never sees a correction. You can always mouse click money. And so you can always support another currency or another bond market. But you will always do that at the expense of your own currency, which you're mouse clicking to support it. So you're not only running up in roller skates, you're shooting yourself in the foot. You can do that for a decade, 2 decades. We've been doing it since 1971. The question is, when do you go too far? And what we're seeing finally in 2025, now into 2026, I think we've gone too far. Our currency, your problem is our currency, our problem for a lot of nations. It's all tied to debt. The debt is everything, and the bond market and the yields reveal it. Yes, you can compress yields by printing money to buy bonds to keep the yields down. But when you print money, you expand credit. When you expand credit, you expand the money supply, you debase the currency.
So, I mean, if you're sitting on the other side of this and you're a career politician and you're being shown, or at least the public is starting to wake up to this, I mean, is that why there's so many talking heads right now?
Oh, look, anyone who reads me or watches me knows the island of misfit toys that composes the Congress and the Senate, from your country to mine to the ECB, which I'm very familiar with, most of these guys know very little about history, even less about economics, even Besant, and more so than Yellen. But I'm saying certainly your average congressman or senator can't count to 2. And I know that sounds dramatic. So to rely on them to solve an economic crisis of this magnitude is really naive. They have to tell a narrative, certainly central bankers, but the politicians themselves have to tell a narrative to keep calm and carry on. But they don't even understand the magnitude. The other thing about democracies, love them or hate them, is they think like they're careerists. Yeah. They're mavens to the system. They need to think about re-election. They need to be popular. One way to be popular is to mouse click money to pay for deficit spending. That's one-on-one stuff. They will not think about the longer-term ramifications of inflation or debasement. I don't think they'd understand it. But even if they did, they would never admit it. And they wouldn't admit it to their constituents. So while they're giving us a CPI scale or an inflation scale or good news about a new spending bill that's going to solve a problem in this sector or that, they're saying that with their left hand, they're hiding their right hand what that means to the purchasing power of the money you measure your retirement, your checking account, your portfolio. It's just an invisible theft. It's a slow death by 1,000 cuts, incremental debasement of the currency. But the incremental is now becoming exponential. Again, hence the price rise in gold, one of the key drivers. And these things are all connected, and they're meant to be diverse and hard. People who have 9-to-5 jobs, whether they're dentists, bricklayers, brain surgeons, whatever, they don't have time to get into the weeds of yields, bond curves, quantitative easing, tightening, Carney this, Powell that. Everyone has their own political opinions, it's very derivative and reductionist, but it comes down to really bad, dysfunctional, drunk driving monetary policy.
Yeah, amen. And it also comes down to, I guess, trust. And again, that brings us to gold. I mean, I know that you've been watching this run up, but let's be honest and just take it out for a second, just between two gentlemen here. I mean, what the hell happened last year? I mean, it happened quite quick, quicker than most thought.
Look, all of us were shocked but not surprised. I mean, we've been talking about this for years. And by the way, for those many years, gold was being mocked by the street as a pawn shop asset or too volatile. Looking back over the last quarter of a century, it's outperformed even this S&P in total return. So there was a deliberate attempt to misunderstand precious metals. We've been talking about precious metals as being a far better store of value, not in appreciation versus the S&P, but in holding its purchasing better than a fiat currency. So what does this mean when we look at $5,000 gold? If I had talked even a year ago here about $100 silver, he's selling his book. I get it. And I totally, my BS detector, when I was allocating money to others, I was always, where is this becoming extreme? And I am very cynical and skeptical, as anyone should be listening to me or anyone else. But do your own homework and think about this and come with your own conclusions. But what we're seeing really in this, what John Rubino rightly called just a horizon of distrust across everything, whether it's left or right politics, whether it's globalism, whether it's immigration, whether it's social unrest, we all have a different opinion. We just don't trust the decisions, and we argue about that. But I think when you look at $5,000 gold, you say, this is a bubble. This looks like NVIDIA, or this looks like Lucent or Qualcomm or Amazon circa 1998. I get it, but it's actually much more disturbing than that. Again, take out my bias if you can. It's what we're seeing with $5,000 gold isn't a sign of how bubbly gold is. It's in a bull market. It's a difference. The reason it's in a bull market is not that $5,000 gold should shock you. What should shock you is how bad fiat money has got, that gold has to be 5,000. It's not just a bunch of retailers going crazy to follow the trend. The bulk of this demand is coming from central banks. Retail sector is hardly allocated at all. You see it on news. It's nothing compared to what central banks are buying. And again, when did Noah build his ark? Before the rain. When do you load your gun? Before combat. When do you stock up on food? Before the snow. What we've just been seeing since we weaponized the U.S. Treasury and the world reserve currency in 2022 is a tripling of central bank gold buying. It should be a massive headline. Why are they doing that? They're building the ark before the rain. They see the rain coming. What are they building that ark with? Gold. I'm sorry, I may be a gold guy, but that's not a bias. The world sees this. The BIS sees this. Ray Dalio sees this. Druckenmiller, Paul, it's not just the gold camp. Even Morgan Stanley sees this. So again, get past, he's selling me something, do your own homework. $5,000 gold, of course it's disturbing, but as many of us and we meant this, I'm not hoping gold gets to 10,000. I'm afraid it is, because if gold gets to 10,000, what that symptomizes, what the symptom of that is a credit system literally burning right in front of our eyes, and a currency system melting in front. And it has been slowly since 1971. Now it's happening exponentially, and that's the real issue. It's the currency. It's the currency derivative of the debt market. It's the explanation of this gold market, and of course the COMEX can't keep up.
No, and we need to get into COMEX and talk about this squeeze. On this, I want to talk, because you keep talking about that gold is currency, and I mean, we've been talking about this for a long time. You have a specific thesis that the next phase might not be gold as currency that we spend in a store, but, the settlement asset for trade. So, I mean, break this down. What does that actually look like?
Well, here it is. I mean, in a way, we're getting our signals from the East, not the West. And whether you like them or not, I have no desire, as I said many times, live in St. Petersburg. I'm not a shill for Shanghai. I'm a capitalist. I'm an American. I live in Europe. I'm binational. I love the West and I love capitalism. But look, you look at the BRICS, Enbridge, all these discussions, de-dollarization that's been here since 2022. We all get it. There was never going to be a BRICS-backed currency, a gold-backed BRICS currency that all the BRICS nations and what they did, because the BRICS countries don't necessarily trust each other, but they do trust gold. And what they're coming up with, slowly but surely in the laboratories of their long-term thinking, is making gold 40% of any net trade settlement in the BRICS world. So they'll do regional currencies and regional trades on anything from energy to widgets, and then they'll net settle that in gold, which is a brilliant idea. That way, each nation has the right to still debase its own currency, because every debt-strapped nation eventually wants the freedom to debase its currency in an emergency. If you have a gold-backed currency in those nations, you can't do it. So that's being realistic. But if you're going to trade, you've got to have a real asset, a coverage, and that's gold. Even the IMF during the COVID hysteria, when they were talking about the new Bretton Woods 2.0, they said in their little chart, if you watch their video, at the bottom of that chart is gold. In the new central bank digital currency dystopia, the only good part of that, for it to have any credibility, it has to have some gold coverage. So gold doesn't become a new currency, but it becomes a part of the ratio. And it's emerging everywhere. And again, that explains why the bad guys are stacking up.
100%.
Watch what they do, not what they say.
Yeah.
I'm not a fan of any of these parties.
Yeah.
But you can't deny, don't fight the Feds, don't fight the central banks. They're stacking for a reason. It's not just because it's a trend.
And I mean, distinguish between, I guess we'd call it transferring debt, which is fiat, versus paying it off, which is gold.
Well, you could reprice gold. You could take the 260 million ounces in the U.S., reprice from $42 to whatever price at spot or maybe higher. And that's a little QE with gold. That takes some of your debt level dents down. That's a whole other conversation. Yeah. But in the meantime, gold will give them some liquidity, but what they'll probably do is they'll just inflate away their debt by debasing the currency and lying about inflation. That's the current mode. And then eventually we'll make it more digital.
Yeah, CBDC, that type of...
Some type of dysfunctional reset where Bretton Woods comes in and we say they'll blame it on anything but themselves. Before it was COVID, then it was Putin, and next it'll be Venezuela. Who knows? They'll be a bad guy. It will never be the bathroom mirror of the very policymakers who for decades have driven us into this wall, in particular the U.S. and the Fed.
Yeah. Especially going into an election on the midterm time. I mean, that hybrid system that we've talked about, I mean, does the dollar have to die for that to happen? It doesn't.
No, it just has to be repriced. Yeah. Who's going to replace the dollar for the world reserve currency? Who has a better bond market than even our bond market? China doesn't.
Yeah.
Who has more? Even with us, even with Trump and all the distrust, the U.S. has some more credibility than any other nation. It also has the cognitive, the memory of it, the muscle memory of it. But its share of FX reserves is getting lower and lower. But it's still a major part of FX swaps. It's still critical to the U.S. The Treasury is critical to derivatives trade, which is another topic of risk. But no, the dollar's not going to be replaced. The Chinese and Russians aren't stupid. They're not going to try and beat the dollar. They're going to go around the dollar, just like a good army would do if they hit a wall like the Maginot Line. They just go around it. They flank it.
So we'll use dollar for commerce, but we'll central banks will use gold for collateral.
So what I do, I save it gold and I spend in fiat when I need to buy something. If I have a big purchase, I'll take some of that gold and I'll liquidate it into fiat, which is functional. I can't go into a Costco with a 100-gram bar or a 100-ounce bar.
Exactly.
But I understand, I respect it. I don't see it being money, but I see it as being a better store of value, just like the banks and the BIS say it is, just like the evidence shows. Again, why central banks have more of it than treasuries. And they've been building that for years. They're saving in it. Because saving in U.S. treasuries and U.S. dollars is saving in an ice cube that's melting. And even the petro trade, the volatility with that petrodollar, it was so much less when it had a gold backing. So even that's getting a little weaker. There's cracks in the oil trade. That's another hour, but it's fascinating too.
Yeah, it's interesting. You know, you and I were chatting a little bit about, you've been in this industry a long time, and obviously you have a lot of clients. I'm sure more are coming to you. How many of them are waking up to supply squeezes? COMEX, LBMA.
Well, look, as we were talking before this, things like quantitative easing, swaps, derivatives, the COMEX, they're meant to be incredibly complex and kind of wonky, and they make your eyes roll. And so a lot of people don't see what I think was the headline of the year last year was the dysfunction in the COMEX, as they should. They wouldn't see that. Why would they? I don't understand thoracic surgery, but if I had a lump in my throat or in my heart that was causing palpitations, some expert could probably explain it. So again, the COMEX is the headline. Most clients aren't necessarily coming in with a sophisticated notion of the COMEX, but they've read and seen enough of our reports that they get the main theme. And I think this is for your listeners important. Probably many of them already know this. Some will know the COMEX better than us. Some won't know anything about it. But I'm not exaggerating. The COMEX, very simply, is where derivatives are used by a handful of banks to legally and artificially repress the price of gold and silver by going short these levered contracts with 4% gold or silver and 96% paper. They do it every morning, and it's been going on since the 70s. Why? Because gold and silver are the antagonist of fiat money. So that it's very important to keep gold and silver under control because it's embarrassing when it rises. It's a middle finger to the fiat monetary system. And so for years, the COMEX and the London Exchange have been very powerful with this. That's why they created it right after we went off the dollar, gold backing. They needed immediately to keep gold suppressed. What happened in 2025 in the silver and the gold markets and the COMEX, again, is meant to be misunderstood. Even if it was on the headlines, you wouldn't want to read it because it's too boring. All it came down to, I'm simplifying dramatically, insulting many of your COMEX experts, is there wasn't enough allocated, segregated, post-Basel III gold and silver on these London and New York exchanges for them to even do the shorts they were used to being doing. If you can't short, you can't manipulate the price. Very simply, that means there's actually a hint of free price discovery in gold and silver. So as this debt crisis and currency crisis collided and pushed gold up, the COMEX wasn't there to put it back down again. And that's what was really unique about the price moves in 25. And look, I've been a trader for decades. I've never seen the lease rate in silver, for example, go above 2. It went to 5. The COMEX in the gold market this summer, literally, it's 1% stands for living. It just gets levered and rolled over, levered and rolled over. That's the COMEX. This summer is 100% delivery for gold. The counterparties on the COMEX wanted physical gold. That's extraordinary. Yeah. It's extraordinary. Again, for those who don't know the COMEX, it doesn't mean anything. But what that signifies is after decades of price fixing, the counterparties would just rather have the gold, again, because they see the rain. They're building their ark. They have to. So what can the COMEX do? And what I think, and the silver markets too, they've tried to manipulate it. They don't have the silver, so now they push up the margin prices. They're trying to come up anyway. Maybe they'll have limit orders. Maybe they'll make it sell only. But what that is saying is they're running out of bullets. And when that happens, and I think, and this is just a theory, is I think they're going to have a failure to delivery on the COMEX and silver. And what that means, again, this is wonky to anyone else. The COMEX is supposed to be able to deliver the counterpart of the silver if they want to take it out. It's not designed for that. It was designed for leverage.
Not designed for a run.
Not for a design. Yeah. And it's like, what's going to happen is going to be a cash settlement only, not an actual delivery. When that happens, that's effectively saying the COMEX has failed. It's what it's contractually obligated to do. That a futures contract is not a contract at all. It's a cash-settled, bogus contract. That would have a contagion effect on other futures contracts, probably next in gold, then maybe in wheat. That could be that type of domino 08 kind of moment. I'm not saying it will happen, but I think it very likely could. And if you see a failure of delivery on the COMEX, that would be extraordinary because the derivative markets are sick. It's sick. It's 10 times higher than it was pre-08. And we have 4.4 times derivatives than we do actual assets in the world. Everything's financialized, extended and pretended, papered and levered. That is a complete clown show. Yeah. And it only works as long as everything is going smoothly. As soon as a counterparty fails or a delivery fails, and no one, myself included, can time it, it's not sensational. We've seen this movie before. It can happen again, only this time in a much more dangerous macro environment, where banks are 10 times more levered than they were in 08, despite Dodd-Frank. They learned nothing from 08. It's extraordinary. Yeah.
I mean, if they did learn, does that mean that this would happen? You know, they're trying not to make this happen. I mean, would this happen this year?
How do I know? Yeah. You know, how do I know? Even the dot-com bubble, I knew it was overvalued. I didn't know when it was going to pop on April 14th, 2000. Yeah. I just got out. Yeah. No one can time it. And my mentors in the risk asset space, where I gave money and where I was mentored, was guys like Jeremy Grantham. He's far smarter than me. Dalio knows these assets. But as Grantham said, you can identify a bubble all day long. No one can time one. And there's so many needles pointing to this. It could be an interest rate spike. It could be an official recession by the NBER, a deflationary moment. It could be a failure in the derivatives market. It could be banking failures. You've got 800 million ounces coming out of the ground in silver. You've got banks with 4.4 billion ounces of shorts against it. If those banks get in the short squeeze on silver, they're going to fail. Has that ever happened before? Yes. We've learned nothing. It's out of sight, out of mind. I know this sounds dramatic.
No, but I mean, history does repeat itself. That's just a fact. You know, what about, you know, we talked a little bit about lease rates here. We were talking about backwardation. We were talking about the Shanghai exchange in comparison to is it still an east versus west? I mean, is still arbitraging everything going east?
Well, look, think about it. I mean, when you see silver $10 higher in Shanghai than you do in London, that's a problem. And look, if I were a nefarious leader in the East, I'd say, and I'm in a currency war with the West, and I am playing these type of games, I'd say, if New York and London can't give you fair price discovery, the 200 moving day average in gold and silver is X, and we can give you real price discovery, of course you're going to change banks, so to speak. You're going to change exchanges. That's going to bring flows to the East. So that's what tactically would be the right thing to do. But remember, China and Russia, they may be smart, but they're not without their own problems and their own need to repress gold and silver for their own reasons to stack it. It's not like they're more moral than London or New York, but they are more clever. They're playing chess here, and we're playing checkers. Yep. They're stacking gold, and we're issuing paper IOUs, and they've been sharpening their knives waiting for this. But it doesn't mean they don't have their own problems. But I think there'll be a fair place there. The problem is, will you trust the contracts? Will you trust the counterparties? Will you trust the liquidity? Will you trust the regulation? Although the OTC market in New York is unregulated, self-regulated. Will you trust China? That will take a learning curve. But if they want to win hearts and minds, they got to give better price discovery. So we'll see.
So
none of us know. It's fascinating.
You know, everyone here at VRIC, obviously it's a little bit of a different attitude. I feel like I was saying to Randy Smallwood just earlier that last year it felt like a $3,000 gold. Yeah. Everyone thought, when's it going to come to an end? Right. This year at 5,000, it's here.
Yeah. And look, and you get no credibility if you're a serious precious metals trader or investor. If you were to say, well, it just goes up and to the right from here, or this is the new floor, you will get no credibility. But on a technical and fundamental basis, what I can say, we've seen 2 8x moves in my lifetime already in the gold price. I think the first time was in 79. Again, this is bear trough to bull high, 8x move, 79. Another one happened in 2001, 8x move from bear trough to bull high. The last bear trough technically was 2015 with gold at 1050. Well, we're in that now. Even with closing at 4,500 last year, that's only a 4x move. We still have another 4x to go. Technically, fundamentally, the gold-silver ratio, the direction of central banks, there's an easy case to be made, technically and fundamentally, for much higher gold. But you also have to recognize that in all bull markets, secular bull markets in gold, you can see major retracements like we saw midway through 71 to 80, where gold got kneecapped in 75 and 76. So anyone thinking about gold and silver, especially as a preservation asset, can say, look, I'm ready for that. I can handle it. I just know my gold will be worth more 20 years from now than what I bought it today. If you're a trader, all power to you. Good luck. Very few people do well. That's more risky. If you just think you can buy gold at 5 and you're never going to have a problem, that's risky. But if you think you're waiting for a pullback to buy it, that too is risky. So you've got to know why you're buying gold. You've got to know why.
So, I mean, that fundamental that you talked about, central banks, obviously, we see the World Gold Council, the reports, we see what people are kind of holding, maybe not China.
Really the U.S., though. Really?
Maybe not the U.S., exactly. But I guess the question is there's finally narrative out there that the banks are the hidden hand here as the buyer from the sovereigns.
Yep.
Are they starting to accumulate this as a currency product?
Well, we don't really know who's taking delivery off the COMEX. And my guess is if I were Jamie Dimon, it'd be Jamie Dimon. He's not stupid. And so that's the great mystery. First of all, let's just do a frickin' audit. Come on, if gold is a major part of the future, whether you believe in it or not, the East certainly does. He who has the most gold wins, as Kissinger said. But he also said, be careful if you revalue gold, because what if some other country, if we revalue gold at 20,000 to cover some of our M0 deficits, well, then that's a new floor. But then what if China does have more gold than us? Then who has the leverage? I don't know. What does Russia really have? The World Gold Council does not tell us not because they're dishonest, because they don't know. Why don't we have the audit? So it's very convoluted. If we had more...
Not this year, not on a midterm year.
No, but that was another, again, not pro or anti-Trump, but that was another promise. It just hasn't been delivered. Peace in the Ukraine, not delivered. Epstein list, not delivered. Look, I'm not anti-Trump or pro. I'm just saying, I'm cynical about politicians in general, but a lot of things have not been delivered. But that Elon Musk, everyone was so excited about this audit. Crickets. Yeah. Crickets. Yeah. Usually there's a reason for that.
Yeah. I got to ask you, I mean, you track that trust metric that we've talked about a little bit, the faith in sovereign credit. I mean, in this environment, after everything we just talked about, I mean, if the Fed is active in the foreign exchange markets, and yields are rising despite these cuts, I mean, have we crossed that threshold? I mean, is it just math now?
I think it is just math, and that's the hard reality of precious metals. Again, doesn't mean you're just going to get rich overnight with gold and never goes down. But everything is a debt crisis, and that means it's a currency crisis. This is as old as History 101. They're just trying to churn and talk and speak around an inevitable sickness, and so they can technically create mathematically different yields and safer quote-unquote flows and help bond markets, but they'll always do that at the expense of the currency. You can save the U.S. Treasury anytime you want. You can buy them all with mouse-click money, some credit expansion, but that will slowly kill your currency. And again, ancient Rome, 1500 Portugal, the Dutch, the British Empire, Weimar, Yugoslavia, the extreme examples, but even the U.S. is not immune, has no impunity, can do it longer, but has no impunity from debasing its currency to the point where it's no longer trusted. When trust dies, that's the end. Not the end of the world, just the end of that system. And so how do you quantify trust? How do you measure trust? Is it how many riots you see a year? How many wars we're involved in? How many social unrest events? I don't know. But we all kind of feel it, and we all kind of see it. And the only way to avoid a real crisis is genuine constructive destruction, austerity, honesty, and living within our means, but that's going to hurt everybody. And I don't think a politician can get elected on that. I just don't.
Yeah, well said. Going into this next year, I mean, what is that kind of, I mean, you've literally, everyone's chasing a price target here at the show, as you know, and you've called this a smoke alarm. So, I mean, for an investor that doesn't watch this like you and me, what do you think that smoke signal is this year?
Well, look, for years, when everyone asks me a price target, I always say, and it's not to avoid the question or evade the question, I say it's going to be meaningfully higher because paper money is going to get meaningfully weaker. And when you're measuring a price in any asset, including gold and silver, in a fiat currency, it's like trying to put a hockey puck into a moving net or throw a pitch at a catcher's glove that's moving. You're just measuring in something that's inherently melty. You can measure it in, as Egon says, chickens or barrels of oil or real estate. But again, $5,000 or $7,000 gold as a price target is a smoke signal that's really not about the gold and silver that we're price targeting. It's about how much we distrust the underlying currency. And we have the muscle memory of most people are good. They trust their central bankers and politicians, not because they're stupid or naive. They just assume that everyone would say the truth. When you've been in our game, a veteran of this combat long enough and looked under enough hoods, that trust died a long time ago. And in a sense, you're an insider. So, and believe me, many of my clients are bankers and hedge fund managers. They're in the system. They don't trust it. So what have they been stacking for years? Gold. So when you have the advantage of being a combat veteran of that space, you know what ammo to use, which grenades don't work, which trenches are safe, which trenches are dangerous. That's not genius. It's just experience. And you try to convey that to other people, and you make them hope they believe you. But if they don't, at least look into it. Don't just be cynical. I would be cynical. I'm the first guy to question anything sold to me. But it's history more than it is economics. It's basic math. And it's the history of currency destruction to monetize debt gone wild. And the fault of that lies in our policymakers exclusively. And this independent beast from Jekyll Island, it's called the Federal Reserve, which is neither federal nor reserve, that sits on Constitutional Avenue and is a violation of Article 1, Section 8 of our Constitution, made legal by Woodrow Wilson in 1913 against his will. So it's a fascinating story.
Yeah.
But again,
most people
don't have time for this. Of course not. I wouldn't.
Yeah.
If I were a pediatrician in St. Joe, Michigan, I wouldn't.
So what about if the most people, there is a retail crowd there that maybe are looking at the gold price. They've seen it in the headlines. I mean, MSNBC's even talking about it at this point, for God's sakes. What if they say, what about the gold miners? I mean, we're here at VRIC. Do you think that there's still an opportunity on this run there?
Look, I'm not a speculator anymore. I'm not at all. And there's a real fat pitch for the gold miners. Whether you know a lot or little, I know a little bit enough to be dangerous, but not enough to be a fiduciary. But it's very simple. When the spot price is significantly higher than the cost of production, that's usually a real tailwind. JP Morgan is creating a $1 trillion 10-year fund to invest in minerals necessary for national interest. Look,
while buying the gold?
Exactly. But I mean, that space is so small. We had $270 billion in the mining space, went to $800 billion last year. That little bit of capital does a lot to push those prices up. Not to mention the momentum, tourist trade of retailers trying to get rich quick, trying to find alpha where they can't find anywhere else. There's a lot of technical and fundamental reasons why the miners could do well. You could do the indexes, you could do your homework on the individual miners. That takes some expertise too. Or you could just put a blindfold on and go with the long index, and you'll probably get a 2 or 3x return. But again, I can't promise that. Yeah. But if we're looking at the price of gold secularly or the price of silver secularly, the miners are going to rip. But again, know your entry, know your exit, and don't take my words, because I am not. I don't invest in these risk assets on the precious metal side. Not because there's nothing to be had there. I just don't have enough skill, and I'm too old and too boring now. I'm just a wealth preservation guy. And I have nothing against speculation. I would certainly recommend people look into the mining space. But there's the Ross Beatties and the Frank Justers of the world, and certainly the Rick Rules too, who know this space better than me. And
amen. Well, here's the thing. We're going to have all three of those gentlemen joining me right here at VRIC this week. Of course, Matt Piepenburg from von Greyerz. It's been so great to talk to you, but also during this run, I got to get you on every quarter, I feel like, because there's a little bit of truth here that we don't get from a lot of other people, and maybe that's for a reason. So I appreciate it.
My pleasure.
All right, thank you so much, man.